Hello, and welcome to the Max Revenue Show. I am your host, Trey Shields, along with the Zen Master of Commercial Insurance, Micah Salas. Micah, how are you this morning?
Lovely.
Awesome. Way to bring the energy. And the $1 Million Man, Mr. Luke Berry out of Tennessee. Luke, how are you this morning?
Doing even better than Micah.
Everyone is overcoming some type of sinus infection or flu or whatever. I am in Austin, Texas. I just got off of a flight to come reshoot a course with Micah, and so I look like hell because I just did a night at Hampton Inn and I don't sleep well. Luke's coming off the flu, and Micah's just just Micah. So it is what
Micah's
it is.
Superman.
By the way, if anyone's suffering from allergies, this is not a sponsor, but go check out NAC this allergy season supplement. It will change your life. I took it last year for the first time. Allergies went from a 10 to a 1 from the months of basically February through April. So NAC, go check it out. Since we're talking about sinus injuries or sinus issues.
Is that a RFK play there? Is that a RFK type deal?
No, I got a blood test last year for work. Speaking of health insurance, we do our annual blood test, talking with the guy, and I was like, hey, I have allergies. Like, have you tried NAC? I was like, nope. And it was like $14 a bottle, and it's all natural. It's just there's no side effects, and it's great. This is awesome. So I recommend it to everyone I talk to.
Very nice. All right, let's start off with the lead story here. WithCoverage raises $42 million to quote unquote fix the traditional broker model with AI. Two tech bros just raised $42 million to replace traditional insurance brokers. WithCoverage, an insurtech startup founded by, doesn't matter, two tech bros that have raised $1 gajillion and built successful AI startups, are basically trying to replace you guys. Here's how their playbook works. Start with an AI-powered policy audit that finds coverage gaps and overpaying. Pair it with in-house insurance experts and attorneys. Run competitive carrier shopping. Charge a flat fee instead of commission. They've had a number of people already hop ship. Looks like they've converted 700 plus startups in the last 18 months, including GoPuff, Eat Sleep, and Blank Street. I only know who one of those or two of those are. Micah, you know who GoPuff is. Am I right? All right.
I don't.
It doesn't look like, at least, I don't think they're attacking quote unquote mid-market right now. Looks like they're kind of staying in that startup space. But we've had a couple of messages from people saying, hey, when are you guys going to cover WithCoverage? So here we are. We're covering WithCoverage. What's your take here, Micah? Does this concern you as a mid-market producer? What do you think here?
I ran it by a couple of CEOs at some agencies, and they're like, yeah, they're just like, wait and see. We're not overly worried or at this moment. What they're ultimately doing is just they have a really good marketing package, right? If you watch the video, it's slick, so that'll probably drive some people in there. They're throwing rocks at what anyone can throw rocks at, right? Which is the kind of lack of transparency around pricing. And even if you go on a commission or a fee-based model, it doesn't really matter. If you're transparent with your client, they're fine with it. That's ultimately what matters, right? So they're throwing rocks at that. And I think most brokers, when you're starting to work on accounts that are $500,000 million plus, which just seems to be what they're targeting, you're going to talk about a fee, I would hope, at that point anyways, especially at that point. I think the other pain point is, hey, your broker doesn't shop, or my broker doesn't shop for me. And they show this slick little graphic of all the companies they shop. They have access to 30 companies. I mean, again, if you're an independent agent, you should be having a pre-renewal strategy meeting. You should be talking about the best markets. I mean, just going and shopping every year to 30 markets is also a dumb strategy too. So if they think that's the answer, that's not. But people get lured in by the bells and whistles, of course. I mean, like the policy analysis tool looks cool. What I would say with this though is there's so many different AI tools out there. Our agency is using a couple. I'm sure Luke's using a couple that do the analysis now and can kind of create something like that. And so I didn't really see anything more innovative from like the policy analysis and that. I mean, they just packaged it well. They're tech guys, and I'd be curious how many of their clients they've brought in were tied to Sequoia Capital or, somewhere tied into their investors. Because they have some big names, Bombas and some other ones, I guess, on there. I think a health bar that I'd heard of. But yeah, I mean, if anything, I'd mentioned this to another friend. He said it sounds like kind of like Zenefits play back in 2015 on the health insurance side.
It's exactly what I thought.
Yeah. And so I think people are like, well, let's just wait and see. Once you start to actually try to run this thing and there's claims that pop up and issues, across state lines with licensing, and there's just different things that make it complex, and we'll have to wait and see. But I think it's something to keep your eye on. I think they do a great job marketing. I think it's a viable look. They look fairly legit. It just comes down to also they're going to need good people behind the scenes, though. If you think you're just going to solely rely on some BDR sales guys who have no experience opening doors, and then all of a sudden people just want to be managed by an AI platform and they're good to go, I just don't think people are necessarily there yet, but we'll have to wait and see. Luke, what's your
Luke?
take?
I mean, I think what they're really selling is not insurance. I think it's just control, speed, and clarity. And I think as a broker, as a consultant, you got to take yourself out of that agent, where you're always quoting, you're putting yourself in a commoditized position. And when you start to think as a consultant, you start to manage expectations. And I don't think managing expectations will ever go away. I think that is the bread and butter for really truly making relationships sticky and creating that trust. I don't think you're going to find many C-suite executives building trust with an AI platform. I think they will always inevitably build trust with a subject matter expert. And I think that's really what you're looking at and what you're seeing in the C-suite in general. If you just read articles in the Harvard Business Review and whatnot, is it's no longer are you with a firm or are you with X, Y, and Z company? What's your resume? It's, hey, can I trust this person? And are they a subject matter expert in all that they do that could actually help me? And I just don't think you're going to get that from an AI platform. I think it'll be a nice tool. I just don't think it's going to be the end all be all.
Do we think that this is ever going to happen? Is AI ever going to replace the mid-market, or is there just too much complexity? What do you think?
I've seen it happen on the benefit side time and time again. Zenefits is just one example. It never works, right? Because everyone at the end of the day, and Brandon with Micah, you guys were talking about this in the last podcast, but in that private equity model, everyone's worried about EBITDA and margin. They're not worried about the client. And so because of that, I don't see it ever working out, because when you go to that model, the client is just a bystander. They're not the actual target for the solution, if that makes any sense.
Micah, you ever think you're getting replaced in your lifetime?
I don't feel like that I will. Maybe. I don't know. It's just everything's moving at such a fast pace, right? I think a lot of it, to Luke's point, I think people still want a human to talk to call, to get their opinion on things. I don't foresee that speeding up that quickly. Maybe 20 years from now, which puts me at age 60. I don't know what things look like. I can't predict the future.
No?
Unfortunately not.
Dang it. All right. Well, let me know when you can. I got some lotteries I need to win here. Moving on to the next story. GLP-1 drugs just became your next ADA nightmare. Luke, this is your bread and butter. The EEOC quietly decided in 2023 that obesity counts as a disability under the ADA. And now in 2026, your clients who've been blanket excluding expensive GLP-1 drugs, example, Ozempic, Wegovy, Mounjaro, from their health plans are potentially sitting on discrimination lawsuits waiting to happen. The safe harbor that used to protect benefit plans from ADA claims is shrinking fast. We don't cover that's no longer really viable. And then also there's another story that says Roe, the telehealth darling, just partnered with Amgen to study why patients can't actually access these drugs, even when they're technically covered. Prior authorization, step therapy hoops, and coverage denials are so brutal that people are running to compounding pharmacies and sketchy online sources instead. If you're not having these conversations with your group health clients, get on it ASAP. Luke, what's your take?
Yeah, so there's a lot going on here. GLP-1s are now the best seller, the newest high ticket item that you're going to see on the pharmacy benefit side of things. That was historically Humira, but with the dawn of the GLP-1s, everyone wants to have a stab at it from a deliverance standpoint. So you're seeing a lot of third-party organizations that are partnering with bigger organizations as channels to help offset that flow for members that are not able to have access to their health plan. And the ADA aspect is just unique in the fact that it's a gray area. And that is, as you said earlier, Trey, that is shrinking and dwindling very quickly. And so it's adding on a whole entirely new landscape to this new drug. And keep in mind, employers are already having a difficult time attracting, recruiting, and retaining talent. And so you really have two schools of thought with the GLP-1 drugs, and that's to cover them, to attract, retain, and just control your talent and keeping them happy. But at the other standpoint, these drugs are very costly, and they add up very, very quickly. And so if you have 30, 40 members that are on these GLP-1 drugs, and at the end of the day, they work for when you're using them, but when you get off of them, the stories are showing for this particular GLP-1 drug, or this new subset of drugs that are coming out, that they really don't work once you stop taking them, meaning that your lifestyle and everything else goes back to what you were previously. That can become an issue. In addition to that, you've got your bone density that you're losing, muscle density that you're losing when you're on these medications. So from a long-term perspective, I'm no doctor, but we really don't know how these are going to play out. I like to look at this as like the old gastric bypass discussion. where gastric bypass was the rage in the early 2000s. And what studies found is long term, the gastric bypass really didn't work. And the members that went underneath the knife to have that procedure wound right back up to where they were 5 or 6 years post that surgery. What is interesting though is these GLP-1s, this is just the first phase. So as I said earlier, this is the first round of GLP-1s that are out. They're constantly tweaking this formula, and they're going to make it even more profitable. And I think you're going to see these GLP-1s expand beyond weight loss. I think it's going to go into a bunch of different profitable, very profitable products for these drug manufacturers. So very interesting. It'll be kind of wild to see it play out. But Trey, I did have a question for Micah though. Micah, are you on this? And this is a little bit of left field. Are you guys seeing any kind of correlation for these members on GLP-1s that are increasing workers' comp claims? Are you seeing that at all?
I am not.
Because of the bone density issues and the muscle?
Yeah. No, it's a valid. I mean, it is interesting. No, I'm not seeing that. But what my mind was thinking as well is in terms of if you're trying to attract a workforce, and this isn't discriminating against overweight people. This comment is not meant to do that. But I don't know. I feel like offering GLPs-1 proactively as a covered deal, I guess I don't know how that would really work to attract the workforce that you probably want to attract, especially, if you're in a physical labor type of job. I get now some people take it because they've tried everything else and they're very obese and it's a good jump starter, right? That's a whole different conversation. But yeah, I don't know where the line's drawn there. And then I just feel like, hey, like you said, it's just going to drive up the health cost. And then my solution is like, why not look at giving your offering a couple $100 a month in food cards or something for like Whole Foods.
Yeah.
I don't know, something like that along those lines, rather than saying, hey, we offer GLP-1s covered on our health insurance. Like that just doesn't seem like a good long-term bet if I'm an employer. You're going to, yeah. Oh.
And I think from the CFO standpoint, it makes sense. It's really the HR. These HR directors, it's hilarious. A lot of them that are asking the questions are asking them solely for themselves because they want it covered, which is great. But,
are you seeing people
funny.
Are you seeing people ask, because you're on the health side more, are you seeing people ask you more from an aesthetic? They just want to look like their 20-year-old self? Or are you getting it from people who are severely overweight and really like, okay, you got to do something? Because I feel like the trend is, it's the people who aesthetics, right? They just want to kind of keep up and have that, be their 20-year-old self again.
Yeah, I would say it's both, but a lot of the correlation I'll actually tie it to are the same people that are asking for Botox for migraines, which again, there's nothing wrong with that at all by anybody that's listening to this. That's not a shot across the yard at all. But the same people that are asking about Botox for migraines are the exact same kind of folks that are asking for the GLP-1s and their weight loss. And again, it's a quick fix. Like it is a quick fix. Now, I've even got family members that are talking and contemplating about doing it. I'm going, just walk. You have a perfect mile that you could walk right down your street and back. Just try that for 6 months before just taking the quick fix on something that we don't have long-term outcomes on.
Yep. No, I get you. And you mentioned gastric bypass. We had a friend growing up, was morbidly obese, friends with my parents, great guy, whatever, did that surgery. And then sure enough, a couple years later, put it all back on and actually had a massive heart attack just last year. He now thankfully survived. But if you don't change unfortunately, you got to just change the habits, right? A lot of it's what you put in your mouth is most of it, and what you decide to eat, Trey, mine's in the gutter there. Anyways, we'll just stop there.
As the only person on this call who has taken the GLP-1, I can tell you I've lost 60 pounds. I'm still overweight. They are amazing, but I've gotten off of it. And I mean, when you get off of it, the weight comes right back on. Because like Luke said, I mean, unless the fundamental eating habits, exercise habits, and everything are there, then it's just a quick fix. So,
and you know what? It is a tool that the market we need, but I just think we have blanketed the need for it over many other things that it should never have been used for. And I think a lot of people are going to have a hard time because they're going to get on that medication. It's going to solve one problem, and then they're on 4 or 5 different medications to solve the problem for the GLP-1. That's the issue at hand.
What I'm interested is there's a lot of people who've had like success with like stopping drinking, stopping drug use, whatever, with GLP-1s, because it seems to like downregulate that mental chatter, needing food or alcohol or whatever. So I'd be interesting what the long-term play is, or like the long-term results are for people who've stopped drinking or smoking using it.
I think that's the next phase.
Cravings come back.
Yeah, I think that's the next phase. They're going to start dialing that in to where you're going to see products just for that instead of just weight loss. It's going to be to cut back drinking or to cut back X, Y, and Z. And really where the issue comes to play is, are they going to allow these drugs to continue to be compounded? And if a drug is compounded, what are the regulations around making sure that is a high quality drug? That's going to be really interesting to see how that plays out.
All right. Next story. Carriers just figured out how to print money with robots. 2 reports dropped last week showing carrier expenses are tanking and AI is the reason. EM Best says expense ratios already fell 2.4 points over the last decade, while Morgan Stanley projects another 2-point drop by 2030 that could pump $9.3 billion straight into carrier operating income. Remote work killed expenses, but AI is the real story. Morgan Stanley analyzed 16 major carriers using Anthropic's data to figure out which jobs get automated. Study says carriers spend so this is basically the gist of it. Over the rest of this year, study says the carriers will spend $3 billion implementing AI in 2026, while only seeing marginal returns. But by 2030, with all systems go, 100% of savings hitting the books, it's going to be wild. So basically, they're getting out in savings what they put into it over the next couple of years. If underwriters are AI assisted, service teams are AI powered, and claims are all automated, why share 12 to 15% with retail agents when they can go direct? What are your thoughts? Is that ever a possibility? Micah, you think you see as things become more automated, AI powered, this, that, and the other, do you see there being a concern with carriers going direct to the marketplace?
I think the bigger concern amongst agencies and agency owners is probably more reduced commissions. I don't think it's going direct necessarily at the moment. I mean, maybe that's down the pipeline. I do think that's a pretty fast return on investment if you really look at it. I mean, to invest that much and have, I guess, what is it called, your hurdle rate or whatever, 4 years in and you're already 100% recouped, and then from there on out, it's a positive investment. But I don't foresee them using this to go direct as much, especially in the commercial. Small business, absolutely, possibly. I still don't think mid-market, complex businesses, even if not even that complex. I mean, a company doing 5 million in revenue or whatever, I don't think necessarily they're going to be going direct online. And it's the same thing we talked about earlier in the segment. I mean, I think they still want a person, like a go-to person, to just handle that. I don't think most people want to add that to their list of things to try to do directly themselves. And so, as Luke said as well, what's going to happen is if you're selling yourself as a commodity, someone who just go get quotes, you're going to eventually be maybe out of a job, right? And I think that the people in this industry who really take education seriously, truly try to learn their craft, to try to bring a different view to buyers and help them think things they're not even thinking about. That's the biggest thing, right? Because AI can regurgitate everything. So it's like, hey, what are you not thinking about? And are you raising those questions to your clients? I was listening to this guy, he on YouTube, actually, the MIT monk. Go check him out sometime. He talks about ghost notes. And basically, it's like all the read between the lines, right? That's what the top executives do. Like they need help with that. And so if you can be the advisor on P&C or benefits and be like, yeah, here's what the data is showing, here's what this is showing, but here's what you're not seeing, and then that's where the real value comes in. So I'm not too concerned, but yeah, I think from an agency standpoint, I think there will be some pressure from carriers to probably press down margins here in the next, or commissions in the next couple of years. We'll see though.
Yeah, I think you're seeing this now. I mean, if you look at the direct writers or your P&C captive options, like I would consider State Farm in that realm, you're seeing even in the State Farm side of things that, at least in our market, where you got some of these sales leaders that they were making too much money from a compensation standpoint, and corporate said, hey, we're done. And now we're starting to see a trickle effect into how that's going to play into the agent, like the actual agents of State Farm. And I think you could say that with farmers or whatnot. But as Micah said, that's going to happen in the smaller market. And I think that's going to be more controlled in the smaller market, because again, that's all they live by is quoting. That mid-market, large market, I just don't see it adapting. And not to repeat everything Micah said, because he said it very, very well, but I think it all comes down to, if you treat yourself like a commodity, you're going to be, commoditized. And so how do you add that value? And I would say this, even on the agency side, we're talking about the carriers becoming more efficient, which is great because their processes have been outdated since, the early 90s. The agencies as well are going to become way more efficient. And so, I would say that one account manager that might have been able to handle 500 to, million in revenue might be able to, in theory, handle 1.5 million. And so doubling that down with your team to create your team more efficiencies might actually help other agencies to where, or your agency to where they're not having to cut comp, even if they might have a carrier do that. And I would just lead with this as well. You're always going to have carriers that cut comp. That's nothing new. It happens with different market cycles. Like the other part of that is you always have carriers that offer more in comp if that's your model. So you're always going to have someone coming in with 15% instead of 12 or 10, and that's just the market cycles. I just would say hold on, be disciplined, keep your head down, and realize that to build a book, it takes time and it takes partnerships, and you've got to go out and find those right partners to help build.
Common theme I've seen in the 4 weeks of doing the news stuff. It's funny, one week you'll read this report and it's basically why, carriers are flushing money down the toilet with AI, or that, most carriers aren't actually using AI. They're, this, that, and the other. And then 3 weeks later, you hear how AI is going to basically cut commissions for all brokers. So these stories jump all over the place. There's a study that confirms, 6 one way and half a dozen the other.
Yeah, and Trey, I would say, Micah, I don't know if you follow industries like this, but our industry, if you just take a step back and on LinkedIn or just reading in general, our industry is one of like 10 that they're all having the exact same conversations. When you get in the weeds, it's different for sure. But the high level, accounting, law firms, brokerage firms, consulting firms for, KPMG, what have you, they're all talking about the same thing. And it's just funny. It's a repeat, rinse, repeat. I don't know. At the end of the day, I think we're being sold something that's not quite there yet.
Yeah, I'm with you. It's interesting. I sat on a demo call with a new company, right, that has like an AI, or basically like an AI virtual assistant type deal. I was really impressed. I mean, I saw from my standpoint, servicing construction companies, a really viable play there to basically not replace an account manager, but essentially, like you said, increase their capacity by taking off the cert load and stuff like that, and be able to do complex certs, not just the basic simple certs, and some other things around that. Yeah, it'll be interesting to see, where this all plays out, and like you said, Luke, I think people's capacities will just get hopefully greater, and margins will kind of stay overall where they are for agencies. But it's interesting.
Yeah, hopefully more A players, come to the, rise to the top, right? I mean, that's the other thing is not everyone, in your agency is an A player. So maybe this might actually give the opportunity to weed out some of the C players and B players to where that A player can really truly shine. So, I think there's opportunity in all of it.
All right. Supreme Court ghosts on Trump's tariff case. Last Wednesday, the Supreme Court issued 3 decisions, but ghosted on the big one, Trump's global tariffs case that's got the entire business world holding its breath. In case you missed it, Trump rolled back into office in January 25 and immediately slapped tariffs on imports by invoking a 1977 national emergency law meant for actual emergencies. Think wars, terrorist attacks, etc. Lower courts called BS. Now Supreme Court is weighing whether presidents can basically rewrite trade policy solo by claiming everything's an emergency. Even the conservative justices seemed skeptical during November arguments. So I guess my question is manufacturing, distribution, Micah, maybe with construction, are y'all seeing the tariffs and the price increases with like cost of goods? Are y'all seeing that in the space, or is it not really hit your clients yet?
I mean, I think on the construction side, you've been seeing a lot of pressure, right? Or at least my clients are seeing a lot of pressure from cost of goods going up. It doesn't seem as nuts as it was back in 2020, 2021 or anything like that. I think it's certainly leveled off. So I don't know if that will now kind of get re-sparked, but it hasn't been like the talking points like it was 2-3 years ago, where it was like on top of everyone's mind, right? You bid a job and then 3 months later the cost just went through the roof. Now it's certainly happening, but it's not like, I think people are adapting to it and kind of working around that, but it's just not to the level it was a couple of years ago.
Yeah. I would say for some of our international clients or clients with international exposure, we're seeing it on import bonds right now. And that's just based on, again, where they're delivering or where they're, getting their materials. With import bonds specifically, they're stacking and layering, and that you could really you could get upside down on really, really quick. Not seeing it from like what Micah said in your rebuild value or anything like construction on the southeastern part of the United States, but the import bonds, we're definitely seeing a lack of predictability, and that's caused some concern for some.
Gotcha. Okay, Micah sent me this next story. By the way, if you're listening and you come across a story that you think we should cover, send it to us. It is not as easy as you think to aggregate stories. So if you have a good one, send it to us, and we'll do it. This one is wild to me. million. The settlement amount Kaiser Permanente just got slapped with for allegedly gaming Medicare Advantage through aggressive diagnosis coding. Kaiser executives allegedly pressured doctors to add thousands of diagnoses weeks or even months after patients had been treated. They'd have doctors sit together at lunch or after work with foods and drinks provided by Kaiser to basically recode their visits with additional diagnoses. The DOJ claims Kaiser received $1 billion from 2009 to 2018 from these additional diagnoses. 5 of the 10 largest insurers in the Medicare Advantage market have either settled a federal civil fraud suit or currently face one similar. So it's not an outlier. I found this absolutely wild. Luke, you want to lead us off with this one?
Well, it's infuriating is what it is. And if you think it's just happening in the Medicare, Medicaid space, you get your head out of the sand. We see this with private insurers all the time, or just from a private. What I mean by that is we're talking from the employer perspective. But I just think it reinforces the need for transparency, audits, and a fiduciary mindset with how you're approaching healthcare. Because at the end of the day, you could pull up any kind of given lawsuit where the DOJ is now, or the DOL is getting involved, where they're suing health plans because of, again, lack of transparency. And again, who's the fiduciary? The employer. Well, if the employer doesn't have access to all their documents, at the end of the day, then really how can they fulfill their fiduciary responsibility? And a classic example of this is, we talk about a PPO network. As an employer, you have a third party administrator, right? So someone that's administering the plan. Well, you have to rent a network. Well, really the only major networks you can rent are, the BUCAs, Blue Cross Blue Shield, United, Cigna, Aetna. Well, none of those carriers will give you the terms of that contract if you're the employer. So you're actually required by the ACA to offer health insurance to your employees if you have more than 50 or more employees on your plan, right? So you have to offer that. So that means you have to go out and buy a PPO contract from one of those carriers. But the carrier is not going to show you the terms of that agreement because it's a two-party agreement that the employer is not privy to. So that healthcare or that PPO contract is between the facility and the carrier. And at the end of the day, there's no transparency for the employer to even see who's winning and who's losing, let alone, what we would call a fully insured model. In a fully insured model, you're not even allowed to own your data because the carrier holds all that data, right? So we can get, in the weeds of this, but underneath ERISA, if you're a self-funded plan, you're required by law to own that data. If you're fully insured, so the employers that are usually 200-300 employees and below, you're really stuck with a gun to your head because you have no control, you have no visibility. And so I would just relate this back to, yes, the Kaiser settlement is infuriating, and that was Medicare and Medicaid, which does hurt our tax dollars. But if it's happening there, I can guarantee you it's happening within the fully insured health plans and even in the self-insurance health plans without the proper procurement of the right vendors. So that's just my high-level take on it. So it's insane.
Micah, do
what
you
about you?
understand any of it?
Well, I understand people acting unethically and lack of transparency. So that's, I think Luke had a great take. I mean, I think to me, it's wild that companies in the 200 to 300 employee space wouldn't have access to their own data, right? And apparently, if I'm understanding you right and other people, it's like when you're in the fully insurance space, that's kind of one of the things you're giving up is just control, access, visibility, transparency, all that stuff, which I don't know with healthcare costs where they're going. I don't know. Luke, I have a question for you. When employers are in that space and they're still on a fully insured plan, why? Like, are they all forced? Because I still hear about quite a few that seem to be in that category and fully insured. Why? Like, why aren't they?
Because it's easy, right? So when you make healthcare easy, it gets very expensive, and some employers are okay with that, right? They'd rather hit the easy button and just kind of move on with life. In reality, the more complex that you make it, right? So that you break it down, Trey, I can't do that. The more you break it apart, right, to rebuild it. So the more you create the transparency, there's some change management that comes in place. And when you're talking to a CEO or the C-suite, they've got A players, B players, and C players too, that CEO might say, hey, my team is just they're not in the model or the capacity to even understand what's going on, let alone the younger brokers that are in the marketplace that are all just parroting stuff they read on LinkedIn, but not to hurt anybody's feelings or whatnot. So you've got these younger guys, younger gals coming to the marketplace that have been doing this less than 5 years, and they're parroting everything they've heard, but they really don't know how to execute. And so you have these CEOs and CFOs and HR execs that have heard the same stuff all over again, rinse, wash, and repeat, but they haven't really been able to find that broker that knows how to execute on those strategies. So If you're a broker hearing this and you're new in the game, become an expert in executing it and not just the talking points, because there are, Trey or Micah, as you were saying, there are executives out there that they want to make this move. They just don't know how, and they don't trust the brokers in their marketplace to do it.
Now, to push back a little bit, I have a buddy of mine, one of my good buddies is an ENT, ear, nose, and throat, and he has done something similar, but not unethically like this. But basically brought in consultants to help him learn how to code more aggressively, because on the private practice side, he's being reimbursed. Like the carriers fight him on everything, like literally just fight him on everything. So they're also trying to play the game to make more money, because specialty physicians, or at least a lot of them, make like half of what they made 10, 15 years ago. So I understand both sides. Same thing with like the personal injury attorneys versus the carriers, the insurance companies, both. It's this tug and pull. So, I'm not saying what Kaiser did is ethical or right or whatever, but at the same time, from like a private practice standpoint, if you're a physician, I mean, they're being reimbursed half of what they used to, right? And they're trying to they went through medical school for all this time. They're trying to make the money that they thought that they were due. So so they're playing the game on their side as well.
So here's a hot take on that. What I think you'll see in the coming decade are less carrier networks and more localizing healthcare. I think you'll start to see more direct contracts from the hospital facilities in the area. They're going to start working directly with the employers at a fair, reasonable cost. So you got reference-based pricing that's out there. You got a lot of other different models for payment and how you benchmark the cost of a surgery, which we'll talk about with Mark Cuban coming up here in a second. But what I think you'll start to see is a localization of healthcare all over again. And I think you'll also will see employers, to the standpoint of controlling costs. I've already got clients that are doing this. They're essentially saying, well, we're just going to hire our own primary care physician for all of our employees, right? We're already doing it on our large workers' comp schedule for nurses and everything. Why don't we have a chief doctor, a chief medical officer that sits within our company, and they're the doctor for every one of our employees, right? They're going to be making just as much as they were in private practice without having to do the billable codes, because it's not needed anymore. And they're actually able to deliver world-class known care to those members. I think that's the model that we're going to start to see. As I've said earlier, we're already doing that in certain areas of the country with our clients. Some areas like California, it's not really feasible right now, but other little pockets of the country, you have a lot of providers that are throwing their hands up saying, we're done with the carriers. We hate them as much as you guys hate them. Now, again, carriers are needed, but when you start to play the game of how much we're going to get reimbursed to our specialists, and we're starting to cut their comp, we want to pay our specialists a lot of money. Like, we want them to take really good care of us. And so that's why I think you're going to start to see a shift in that. And whether or not carriers keep up with it, it's going to be totally up to them.
Great segue there. Maverick billionaire Mark Cuban reignited his healthcare crusade on X, asking why insurance companies pay $2,500 for an MRI when there's a center down the street that'll do it for $350 cash if you don't have insurance. He's pointing fingers at the cozy relationship between hospitals and insurers who inflate prices through backroom negotiations, then pass the bill to employers through skyrocketing premiums. A Cuban's solution: cut out the middleman entirely with transparent pricing like his cost-plus drug company model. This is all you, Luke. What are we looking at here?
Yeah, so just to kind of give you an example of how this game's played. So when we're talking about contract negotiations, you guys have probably seen it play out in your market. I know if you're listening to the podcast today, just think about your own marketplace with the hospital facility that you have in your area. Typically what happens is a carrier will come in, they'll target a hospital facility. Usually there's two, maybe there's three, but they'll target one of those hospital facilities, and they'll say, hey, we're one of the best carriers in the country. We want to deliver, we want to bring you, Mr. Hospital Facility, all of our membership in that area. And I'm not naming any carriers, but they'll go to that facility, and it'll be a really nice, cozy relationship, and they'll sign usually a 5-year contract. In that contracting term, everything's fine up until the renewal comes up with that, and the carrier comes back in, and they go to the revenue cycle manager at that hospital, and the carrier says, hey, we gave you 60% discounts, right? We told you we're the steepest in the market, and that's why we're able to get all the membership to deliver and drive and steer to your great facility. We're actually going to need like 85% discounts. And the revenue cycle manager at that hospital, again, just in theory, goes through and says, well, we can't afford that. Like, we can't afford to give you guys deeper discounts. So they go back to the board, they have a great conversation, and they come back to that carrier and they say, hey, we figured it out. We're going to give you 85% in discounts. Meanwhile, all they did, the hospital facility, they increased the cost of the very good that they're rendering services to through the carrier in order to give them a discount. So at the end of the day, you're actually getting a PPO discount off of a very inflated good. Adding to what Mark Cuban's saying, let's cut that process out. The largest purchaser of health insurance in the entire United States is Medicare. So if we can tie the benchmark for cost to Medicare, then we have a baseline. So if we look at hospital facilities, on average, let's just say they make about 12.5% net profit off Medicare. You can make the argument that that's not the case, but just depending on the region, let's just call it that for this example. So if they're making 12.5% net off of that, that's a pretty good pricing model. And if the hospital in that area says, hey, we need more money on certain lines of coverage for our specialist or whatever it might be, or our NICU, lines of coverage, it could be our outpatient, we'll pay you more. We just want transparency in that. And so what Mark Cuban's saying is essentially localized healthcare. So let's take all of these outpatient facilities, right? Anything that can be done in an outpatient, let's have the employers pay cash directly to that outpatient facility. And instead of spending $80,000 on a knee surgery, we can then have the employer spend 28 grand on that knee surgery, right? It's same facility, same doctor, same process, except we're not dealing with the insurance carrier as a whole. Oh, look, sure, it could be a premature baby. Those things, those are inpatient hospitalization visits, right? You're going to be in the facility long term. That's not what he's talking about. He's talking about your MRIs, the low hanging fruit that you can go to an outpatient facility, get in and get out, and you're back home, right? To where you're not just stuck in the hospital where they're charging you $1,000 for an Advil and a pillow. So there's a lot there, but that's really what he's getting at is low hanging fruit going directly to the provider and cutting out the middleman and the cost for the same result, just less money.
That kind of reminds me of when you're talking about like the solution that they came up with. Hey, we'll just inflate the price and then give a discount off that. So and we get the same dollar anyways. I used to work in finance for a third-party finance company. And so we came out with a 0% interest, program back in 2008. And so you go to somebody selling office furniture. It's like, hey, instead of going to your clients and saying, hey, this is your interest rate and all that stuff, just build that right into the cost of it right away and say 0% financing, and they're paying 15 grand for that couch instead of 10 grand, right? But they don't know it. And, there it is. But it reminds me of that. So it's interesting.
Well, and two, I'll tell you, we had a carrier this year, my daughter's private school, we moved to a self-funded model and we had a really engaged C-suite and we kept them with their current carrier and all that fun stuff, but just moved them into a self-insured model. Well, that carrier came out and they said, hey, we're no longer allowing anyone to carve out your pharmacy benefit management. Well, this particular carrier makes 30% of their net profits a year from owning the pharmacy benefit management contract. So they're cutting out your ability to go through and carve that out. And they said, hey, but by 2026, by the end of the 2026 year, we're going to have to own that relationship back, even though your employer's saving, 200 grand this year by moving that. But by the way, if you do move this back to us, which we're requiring, we're going to start paying you guys bonuses in order to do that. So the incentives there are just absolutely mind boggling to where, the employers need to learn how to ask the right questions, but two, just for what it's worth, if you're the broker and the knucklehead that's doing that and taking those commissions, it will catch up with you, right? No one comes unscathed by doing that. And I've said it before, but if you make a financial decision for yourself to earn more money based on for your client, based on a partnership, I've never seen that work out well.
You cut out there for a second. Real quick, I'd be remiss if I didn't shout out our sponsor for today's episode, Insurance X-Date. Generate leads, win new biz. Insurance X-Date is where new business begins. Industry relevant data delivered on a software platform built for sales, not research. Identify and engage with prospects in minutes. Keep track of your opportunities and get production done. PNC guys and EB guys, they got data for both of you. So go check them out. Guys, let's wrap this up. Anything else, any parting shots you guys have before we put a bow on this thing? Micah?
No, I don't have anything at all other than, guess we'll have to see what is it? Openwell, or I don't even know what the new AI company we just talked about. Coverage. There's a great, cute name. Yeah. Let's see what happens and just keep bringing value. That's the main thing. Keep learning.
All right, boys.
Always keep learning.
All right, we'll send it there. We appreciate you listening. We'll catch you on the next one.
Adios.